Have you ever wondered what $1 million stock portfolio looks like? Well, I'm about to show you mine. And there's obviously a lot of ways you can do it. I'm going to take every one of my stocks. I have 120 stocks. Stocks ETFs, I have 120 positions total. I'm going to break down each one for you in different buckets, from dividend growth investing to growth to speculative to ETFs to cash. I'm going to show you exactly my strategy, how I got to where I'm at today, and I'm going to go through and give you the dollar amounts as well for each bucket. Quick story about my background. So I didn't come from money. I didn't come from, wealth or anything like that. Humble family, humble beginnings. And my story is really about grind. So just, at a young age, I was the kid selling lemonade. I've always had a job. I've always made money, and I've always found a way to get the things I wanted by working hard and being creative, thinking outside the box. And I started investing in 1999 with about $50 a month, and I grew that over time. I actually learned the hard way, like a lot of investors. And the reason I started this YouTube channel about a year ago is I wanted to help others, because when I was in my 20s and 30s, I didn't really know what I was doing. I didn't have anybody. I didn't have a mentor. And I wanted to offer that. And there's a lot of channels and people pushing different classes you can buy and charging you for this and that and scams and all that. This is a free channel. Obviously, there's ads once in a while. I make a few bucks on it, but that's not why I do it. I'm not trying to sell you a class. I'm not trying to sell you a chat room. I'm simply here sharing my experiences, my knowledge, trying to help make you a better investor. So if you want to be a better investor and this sounds good to you, go ahead and hit the subscribe button, bottom right corner. Hit the little bell to get notifications. Now, before I get started, I actually want to tell you another story, and it's about the creation of this video. Now, I've been working on this video all week, and what you're about to see for the majority of the video is recorded about 2 days ago, and the market's up huge right now. You can see Dow is up 3%, S&P is up 2.7, Nasdaq's up 2. All the numbers, the video has already been created, so everything you see is going to be about 3% less. Boeing is one of my holdings. Carnival Cruise Lines is one of my holdings. Those are up 10, 15% today. So the numbers are going to give you an idea, but I actually had a heck of a day. So just keep in mind they're about the portfolio itself is about 3% higher today. I also want to point out that if you don't want to watch this whole video, because I realize it's long, I've got timestamps down in the comments. So jump to the section that you are interested in. Feel free to jump around. Feel free to come back, bookmark this video. I promise you that this video is going to have a lot of helpful tips. As I go through each position, I'll tell you why I bought it, and I'm going to tell little stories here and there along the way that might help you on your journey as well. You'll be very surprised if you've watched my channel that this portfolio is very balanced. I love hyper growth, cloud technology, and I have a lot of that in my portfolio, but I also have a lot of blue chip dividend type stock. So welcome aboard. Hope you subscribe. Okay, so this is hilarious, guys. So this is actually the video that I created yesterday, and I uploaded it to YouTube, and I watched it last night. I was about to publish it and to release it, and decided it was just a terrible idea. I thought really hard. I bounced my ideas off some friends. I bounced ideas off the Facebook group, the Fired Up Wealth Facebook group, and I decided that this was not the best way to go about making the video to do a portfolio update. What you're seeing on your screen, this is actually the video from YouTube, and I literally talked for 20 minutes. I didn't even have my face on it. There was nothing but the screen that you see, and my face wasn't even on it. And I talked for 20 minutes about every single one of these holdings. But I realized that it doesn't really add any value. So what you're looking at right here, this is a taxable brokerage account. All 120 of my holdings, it's over $1 million. This is from Fidelity Active Trader Pro during a live trading session yesterday. What I did is I took everything from my portfolio. I broke it down into different buckets. So if you're familiar with the growth portfolio video I did a couple months ago on April 4th, I actually showed you what I would do if I were to start a growth portfolio that day and what I would put in each bucket. So ETF bucket, dividend growth investing bucket, a growth stock bucket, etc. I'm going to take my portfolio, dissect it, show you every single holding that's in it, show you the dollar amounts for each bucket, and basically just lay it all out there. So this is everything, guys. This is the Fired Up Wealth taxable brokerage account. This is what I'm going to use to retire early on dividends. It's got a mixture of everything from ETFs to dividend growth investing for Fired, to speculative stocks, to cash, to rebounds. Everything's all here. Get comfortable. Stay tuned. All right, this is kind of a cool angle, something different. So I already made this part of the video and I wasn't happy with it, so I'm coming back and redoing it. This is going to cover the ETFs. I'm going to break down all the ETFs that I have in the taxable brokerage account. Now, I do have several other accounts. So again, this is just the taxable brokerage account. I do have things like ARK and Sky that I've had videos on. I still own those ETFs, but they're in different accounts. So let's just get into this. QQQ is my largest ETF holding. ITOT, which is an S&P 1500 or total market index. A combination of VU and IVV, and it's a long story, but essentially IVV at Fidelity used to be zero cost for iShares. There's no commissions. Now VU is no commissions as well because there's no commissions on anything. So I prefer VU over IVV. It's a little bit less expense ratio. I need to convert the IVV into VU. VOIM, which is the Vanguard high dividend yield. I like that one. I need to grow that more for retirement. SOX, that's a semiconductor ETF. It's SOXX. There's also an SMH, but I prefer the SOXX. DGROW, which is a dividend growth investing ETF. A lot of you probably have heard of. And then WCLD, which is a favorite of the Fired Up Wealth group. We've been investing in it for a while. Made a video several weeks ago. We were kind of one of the first ones on YouTube. I think the first one on YouTube. If you just saw on the TV, there was an ad on CNBC for WCLD. So I thought that was entertaining. So how much do I have in ETFs? The number's a little higher after today because we had a big run. When I recorded the video, it's $297,000. So there's over $300,000 in ETFs. And if you watch the how to create a growth portfolio video from April 4th, I recommended that you had about 25% of assets in ETFs. So my portfolio matches that target goal at about 25%. Next, I want to go into my core holdings. The reason it's important is these stocks have heavier weight. So there's more money in these stocks than the rest of the portfolio. Amazon, I've been long since $500. Been telling anybody that will listen to buy it since it was $500, $1,000, $1,200, $1,750. I've been bullish for a long time. I've made a lot of money in that stock. Microsoft, I've had for a long time, several years, continuing to drip the dividends. Nvidia, another great one we've had since about 150. Now, Cisco and AbbVie, both of these stocks were bought by profits from growth stocks. So the idea, my methodology is I try to outperform the market with growth stocks. I then sell those growth stocks for profits, and I buy blue chip dividend growth investing stocks. So these are free shares, Cisco and AbbVie, that are paying me dividends, and that's how you do it for passive income. That's how you got to retire early on dividends. Apple is another one that I've had for a long time. Google, had that one for a while. Splunk. Now, what's great about Splunk is it was a smaller cube. If you remember that heat map that we just looked at earlier, it was one of those smaller to mid-sized cubes, and it grew into a larger cube. So that's what you want. You want your money to grow and grow into these bigger chunks, and then when they get to a certain size and you're ready, you sell those, or you shave them, and you convert into the blue chip dividends investing stocks. AT&T is another one that was bought for with profits from growth stocks. Home Depot, been in that for a long time. One of my favorite places to shop. Lamb Research, great company. If you haven't seen the DGIF video series, there's an entire series that breaks down every sector. So there's a healthcare video, there's a technology video, there's a consumer video, on and on. And Lamb Research is one of the top technology dividend growth investing stocks in there. Costco, had that one for many years. Great place to shop, of course. That's where we do all of our shopping. ServiceNow, one of my favorite cloud stocks, has been in the portfolio for a while. Disney, everybody's got to have a little bit of Disney, and then Bank of America. So these are the core holdings. And as we're going through the video, if you see a little caret next to one of these stocks, that simply means that it's one of those core holdings. All right, so up next we have the dividend slide. So this is going to be dividend growth investing for Fired, DGIF, but it's also going to have some ZGI mixed in. And you can see, so you've got each sector: financials, healthcare, technology, consumer, and the consumer has consumer discretionary and consumer staples, and then industrials. There's already a dollar amount for you on each of those buckets, so you can see what each sector has in terms of value amounts. And then at the end of this slide, I will do a total and we'll compare it to what the percentage is from that growth portfolio video I did back in April. Again, this is a combination of DGIF and DGI. If you don't know what DGIF is, it's dividend growth investing for FIRE. It just means total growth. So you want your dividend to grow, each year and have your dividends continue to grow and to create more income to outpace inflation. You also want the stock to do well and to actually have the stock appreciate in value. So you're getting growth on both ends. When you think of just a straight DGI, I think of like an AT&T or an Altria, where it collects a yield. It's more of an income type stock. It's not going to grow a lot. The stock's not, going to appreciate a lot in value. So that's that's how we differentiate the two between DGIF and DGI. So let's just jump right into that, to this, and we'll start with financials. So what stocks do I have in my financials bucket for dividend growth investing? I have JP Morgan Chase, of course, and if you watch the video on DGIF for financials, that was one of the top picks, as well as Bank of America. Bank of America is also one of my core holdings that we just talked about in the last slide. And before I go on, the legend there, if you see a caret like you do here with the Bank of America, that just means it's a core holding. I did my best to mark each one of those just so you could have a reference as we're going through. And then the asterisk, anytime you see an asterisk like with JPM, any stock that has an asterisk behind it means that I bought the stock with profits from growth. So I took a growth stock, I made a big profit on it, I sold the profit, and I bought a blue chip dividend growth investing stock. So that's what that asterisk means when you see it. Visa's the next one, no brainer, got to have that in your portfolio. Same with MasterCard. They don't pay high dividends, but they do have dividend growth. And of course, they have a lot of, they really act like growth stocks, but they happen to pay a little bit of dividend, just like a Nvidia. And I like those kind of stocks in my portfolio. This is TD Ameritrade. And I don't own a lot of that, but I bought it before the whole COVID thing, and it's beat up a little bit, but I'm holding it. I think it'll be good long term. BlackRock pays a nice yield. I've had it for a while. It was one I bought from profits. So if you're familiar with iShares, they own iShares like the ETFs, but they're an investment banking firm. If you know who Larry Fink is, you've probably heard of BlackRock. U.S. Bank, I used to live in Minneapolis, so I'm familiar with U.S. Bank. It's headquartered out of there. The Nigerian brothers also from Minneapolis, so they like to trade, and I think Pete even owns U.S. Bank, so I do own this. I was able to buy it during the dip, and I got it for a pretty nice price. I owned a few shares before the big drop, and then I added a significant portion to that. So I've got a nice little holding in U.S. Bank. It's actually green. Pays a nice yield, boring, simple. Goldman Sachs, I probably have more of this than I should have. I bought it with profits a long time ago, and it just literally has done nothing. So that's one. After making this video, I learned a few different things. I've got about 120 holdings that we're going to cover throughout this video. So, stay tuned through it. Like I said earlier, there's timestamps. You can jump around, but you're going to learn a lot in this video because I'm going to talk through it just impromptu, not scripted, and I'm going to give you what's on my mind for each of these stock picks, and you'll probably get a tidbit, some good nuggets of information to use for your own portfolio. It also gives you an idea of kind of my mindset of how I operate when I'm trying to invest. I'm trying to take profits, like I mentioned in the beginning of the video, take profits with growth stocks, sell the profits, convert profits into DGI. And that's what Fired Up Wealth is all about. So Fired is financial independence, retire early with dividends. And that's the whole philosophy behind it. And I've got a very balanced portfolio. When I was younger, it was more growth. And as I've done well over the years, I've been investing for over 20 years. I've converted profits into these blue chip dividend stocks. So that's the whole idea behind the methodology. Ally Financial is another one I bought. And I bought it before COVID. So that one is, I think it's down 20-30% still. Holding on to it, I still collecting a dividend on it. It's one that hasn't cut dividend as far as I know. Healthcare up next here. So you can see that the financials, you got $60,137. So decent amount in there. Pretty good yield on that 60 grand. So healthcare, you got United Healthcare. If you watch the DGI investing series, the DGIF series, the healthcare video, United Healthcare was number one. It's my favorite healthcare stock for dividend growth investing. AbbVie, that one is a core holding. It was also bought for with profits. And these are great stories because I took a profit. I bought AbbVie in the 60s, and I've added a little bit since then too, but I started buying it in the high 60s, mid to high 60s. And so you're taking profit from a growth stock, you're putting it into something that pays 6.5% dividend yield, which I feel is a safe dividend. And it's appreciated from, $65 to $95. So you're making 30% gain on profit that you've already taken from another stock, and you're getting that safety with the 6.5% dividend yield on top of it. That's that's how it's done, and it's sweet to see it. It really helps the portfolio grow, and it's fun to watch. So Medtronic, one I actually recently added. And the reason I added Medtronic is because of Hugo, which is their robotic surgery group. And this is a competitor to Intuitive Surgical. And they've got the means, the scale. They've been around forever. They've got the network. They can easily penetrate that market and take some market share from Intuitive Surgical. So I do own Intuitive Surgical as well, and you'll see that on the growth slide. But Medtronic is one I've recently added, and I do like this one long. CVS, one I bought with profits. I bought it when it was really beat up. I want to say maybe this time last year, 2019. So spring of 2019. I want to say I'm up 25% on it. Pays a 4.5% yield on cost basis. They acquired Aetna. So, I like that play a lot in healthcare because they are diversified now, having that healthcare arm and then having the pharmacies. Every target that I know of has a CVS in it, which I think is great. BMY, this is Bristol Myers Squibb, and this is like owning Celgene with a dividend. So if you don't already have some Bristol Myers Squibb, take a look at BMY. Celgene was one of my favorite, cancer stocks, and it did well for a long time and then got destroyed around 2017, 2018. And because of that, Bristol Myers was able to pick them up pretty cheap. But they've got really good pipeline on the Celgene side and oncology, and I think that stock is going to perform well. It already has. It's up 38% or something since I bought it. Johnson & Johnson, another just solid blue chip that I bought. Bought it when it was beat up from the whole talcum powder lawsuits. This is LeMaitre, which is on the healthcare DGIF series. Take a look at it. It's a micro cap, either a small or micro cap. It's tiny. And they do surgery equipment for basically like cardiovascular, like working with veins and things like that. So not the best explanation, but it's medical device maker and it's specific to vascular type research. Gilead Sciences, I bought this before COVID, and it was just kind of random luck because it was something I bought with profits, and it paid like a 4% dividend. I thought it was just a nice value play when then the whole COVID thing happened, and it's ran up pretty well, so I got lucky with that one. Cardinal Health, bought it when it was really cheap in 2019, up big on it, almost I think it's a 4.5 to 5% yield that I got it. So I like buying these blue chips that are beat up when they are paying a high yield. I do the research to make sure the dividend, safety score is there. And then I pick them up when they're beat up and, let them ride some profit and keep collecting the dividend. And I just reinvest those dividends in drips. So I really like my healthcare bucket, about $80,000 in there. Really solid companies, great dividends. Now, technology is next. And with technology, here you're going to have the core holdings. So if you take Apple, Microsoft, NVIDIA, and Lam, it's a significant part of the portfolio. Apple, Microsoft, and NVIDIA is over $100,000, and Lam is close to 20. So you got about 120,000 between those four stocks and the technology. So those are core holdings. They're also DGIF, all pay a really healthy dividend. NVIDIA is a lower dividend, but like Apple, Microsoft, Lam, you've got, that 1.5% type, 2% range dividend where they still have a lot of growth. They can reinvest some of their money into future projects, into future growth. And that's the kind of business that I want to be involved in. So Skyworks is a 5G play. If you haven't taken a look at Skyworks, it's a good one. Cisco is another core holding. That one actually I bought with profits, I'm basically par on it because I bought it before COVID, and then it dipped really hard. I added a little bit, and now I'm sitting right around par on it. But it pays, 3.5% dividend. It's got, solid opportunities in front of it with the whole cloud and 5G, secular growth trends. So I do like that one. Broadcom, I bought Broadcom with profits, and I bought it because they have CA Technologies. If you're not familiar with CA Technologies, they actually have some products that compete with things like Datadog and Splunk. And I just like the fact that it's, it's a semiconductor company that's diversified into software, into some SaaS. So I really like that. And it pays a really healthy dividend yield, over 4%. Qualcomm, another semiconductor, good yield, 5G, lots of different opportunity. Anything in the semiconductor space, honestly, there's so much opportunity right now. So you got Applied Materials. Speaking of semiconductors, here's Applied Materials. It's similar to what Lam Research does. Intel, this is one I bought, beat up in December of 2018. I got it basically for free, it felt like. Really, really good pickup on it. I can't remember exactly how much it's up, but it's up pretty significant, and I think it has a lot of long-term, opportunity. They acquired Mobileye, which does autonomous driving. I like them for that. Texas Instruments, they also do a lot of chips, microchips for autonomous driving. You can kind of see a trend here, guys. A lot of microchips and semiconductors. This is the future. Everything has chips in it. If you're not sure which one to buy, in the beginning I covered SOXX. That's the one of the semiconductor ETFs. There's also SMH. Both of those semiconductor ETFs are good. Take a look at those if you want some exposure. Xilinx, another semiconductor. This one hasn't performed well as of late, but I like them for their MIMO boxes, which could be significant with the 5G play because MIMO boxes are needed to kind of help boost the signal in neighborhoods and things like that. So each one of those MIMO boxes usually uses several chips, and each of those chips is pretty expensive. So if that does catch on, there's a lot of opportunity for Xilinx to do well. IBM, one I bought with profits. They acquired Red Hat, and I do like their potential growth opportunities, but they pay a nice yield. And so it's just one that I bought with profits to collect, dividends on, and it has upside. And those are the kind of plays I'm looking for. Moving along to consumer. Again, this is consumer staples and consumer discretionary. It's kind of a mixed bag. Nike have been in this thing since like 2012, around the time the NFL got their first Nike deal. I said to my wife, we got to buy Nike. It's going to be huge. And, they've grown in everything from college to, to soccer to, whatever. Nike's a great brand, a great company. They got the Jordan brand under it too. They're not going anywhere. It pays a good dividend, not a high dividend, but it's a solid DGIF. Home Depot, talked about a little bit in the intro, but just love the store. I've been in the stock for a long time. It just does well. Costco, same story. Now I've got AT&T and Verizon in here. Both of these were bought with profits, so pretty nice dividends on both of these. I have them under consumer. They're really, communications, which would be under tech, but tech was already full up there. So just make note that AT&T and Verizon are technically communication services, which would be separate from consumer. But you think of it, it's almost like a utility anymore. Everybody's got a cell phone and they're going to pay it every month. So I look at AT&T and Verizon almost as like my utility plays. You can see I've got no utilities. I've got no energy. I've got no REITs or anything like that, real estate. None of those are in my taxable account. I do have some of that, but it's in my retirement accounts. STZ, this is Constellation Brands. They have a major ownership component to Canopy Growth, and I like them for that opportunity, but I also like their brands on the alcohol side with Corona, and they own a bunch of the Mexican beer brands, and just I think there's a lot of opportunity there, and it's a good dividend payer. Foot Locker is kind of a rebound play in the retail space, and I bought it. I actually have owned it for a while, and then I added in March when it got completely annihilated. So you'll see it out here. It could have been. I've got another slide later that's going to show you some value plays, some rebound plays, and Foot Locker could have been on there, but since I own some already, I just included it on here. under consumer discretionary, if you've seen anything with the recent events on the news, with people, entering stores and taking stuff, Foot Locker seems to be popular. So I'm not sure how that's going to impact things. I actually think this sounds terrible, but I think, Nike actually will be a beneficiary, because I see people walking out with 20 Nike shoe boxes, and insurance is going to pay for all that inventory to be replaced. I mean, obviously the people, not going to buy it, but if someone is taking 10 pairs of shoes, they're probably not going to buy 10 pairs of shoes. So I don't know. I'm not trying to get political, but it is an interesting thing to think about, and kind of where my mind goes when I start thinking about the stock market. Altria, Sinstock, cigarettes, Marlboro, it's there. It's something I bought with profit. It's there for yield. It's a true DGI. It's not DGIF. I'm in the red. I collect the dividend. That's what it's there for. McDonald's, don't need to talk about McDonald's. It's more of a real estate play for me. Disney, it's a core holding. When the economy does come back, Disney is going to be an unstoppable force with, everything they've got going with cruise lines and Disney Plus, and they own everything, own Marvel, Disney World. I mean, just on and on and on. It's a great company, and it's one, I've got kids. I've got 2 little girls, so you almost have to own Disney, and they have some in their portfolios as well. Tyson, one of my worst purchases probably ever. I mean, I had this as a top pick for 2020, and it's just, you think that it would do well with all this COVID stuff. All the, consumer staples companies have done well. These guys just don't have their stuff together. And, what can I say? It was a bad purchase. It hasn't rebounded, collecting a dividend, and hopefully it'll come back. It's one that I wish I probably didn't buy, and everybody's got those, everybody's got those. I can say so far everything on here, either I'm up big on, or if I am down, I'm not worried about. Tyson's just one that, I probably never should have bought, and I bought it too expensive. So, not perfect, and just telling you what's on my mind as I go through this. You're either going to love it or hate it. If you really are interested in how my mind works, this video is going to be great. If you're just stopping by, like I said, feel free to fast forward, jump around, whatever. By no means do you have to sit through and listen to everything if that's not what you're looking for. Industrials. So Honeywell, which I recently bought, and we timed it great. We communicated in the Fired Up Wealth group on Facebook, hey, I'm thinking about entering into Honeywell. We timed it almost to the bottom. We added as it kind of dipped, and that thing's up like 30%. So well played there. Pays a nice dividend. I'm going to hold on to it for a long time. L3Harris Technologies. You'll see in the industrials, it's not my favorite sector, and I'm not very good in this sector. I've had really bad luck over the years in oil and industrials. And so most of what I'm going to usually buy, I'm going to buy with profits from growth, and I'm usually going to buy aerospace and defense. And you're going to see Raytheon. There you go. Another one bought with profits. Leidos. I need to do a video on Leidos. If you haven't heard of it, it's a really awesome company. It's technically in aerospace and defense, but it's tech, and they actually do everything from cloud implementations to it's really cool. It's a services type company that it's almost like an Accenture that's built for aerospace and defense. It's pretty cool. Technoglass is a South American company that does modern glass for skyscrapers. It's a really cool company. Used to pay a really high dividend, but they recently cut it with COVID. And so it does pay a dividend, but it's, literally went from 6% to like 1%. And I am in the red on this one, but I am holding it, and I'm very confident that this one's going to pay off at some point. International Paper, it's just there for yield. It's not exciting. I thought it was going to do better with the whole toilet paper thing. They make the pulp that is used for toilet paper. And so trying to get cute, like, I'm going to buy International Paper because everybody's hoarding, toilet paper and stuff. And so far, it hasn't really played out, but whatever. Boeing, I'm down on Boeing. I was buying it in the 200s. I added when it was down, but I'm still down. Dividends cut and all that. So it's one that, a couple of these, the dividends might be cut, whatever. But it's suspended. So they're going to eventually open that dividend back up. I don't know where else to put it because it's not growth. Doesn't fit anywhere else. So there it is in the industrials, but do note that Boeing is, the dividends cut and it's beat up, but I think it's one that will rebound as the economy rebounds. Dow, this one just never worked out the way we thought it would as investors. You remember there was Dow DuPont and they made a three-way split into three different companies. And, usually that benefits companies, but in this case, all three of them, the stocks are red. There's two other stocks. There was DuPont and Corteva, and I sold DuPont and Corteva. They haven't done anything either, and Dow has really just been sitting there collecting a dividend. So, I told you in the beginning of this section with industrials that I don't have good luck, and Dow is a great story. Just don't know enough about the industrial space to be playing in it, and quite frankly, I should just be buying ITA, which is the aerospace and defense ETF, and that's what I do in my retirement accounts. And then UPS, I have no idea how UPS is priced where it's at. It has a good yield, but you think with the stay-at-home environment that they would just be crushing it, but they're not. So whatever. But there you go. So you can see, industrials. There's a few dogs kind of in there. Consumer maybe too. Everything like in healthcare and technology, those stocks have crushed it for me. Financials, they're all solid. They pay a dividend. I can sleep fine at night owning JP Morgan. I know a lot of people think that banks are going to go out of business and cryptocurrency is going to replace them, but I just don't see it happening in my lifetime. I'm 40 and maybe it'll happen someday, but I don't think it'll happen anytime soon. And maybe I'm wrong, but I just don't see the big banks going anywhere. They're not going to crush numbers. They're not going to make you millionaire, but they're going to pay you a nice dividend, and they're pretty stable. So what does this all equal? Financials 60,000, healthcare 80,500, tech 195K, consumer about 109, industrials 47. You add that up, and you get $491,591. So that is about 40% assets. And when I made that growth portfolio video, I told you to do about 20% as your goal. So why is mine double that? Well, the answer is when I made that video, it was intended, if you go to that video and watch the beginning, there's assumptions. The assumptions are you have at least 100 grand, that you're younger. And that video was really geared towards people 35 and under. And I'm older than 35. And so I'm nearing early retirement. And because I'm doing that, I've already started to convert more of my growth into these dividend growth investing stocks, like we talked about with Abby, like we talked about with, Cardinal Health, all the ones with asterisks up here. Okay. So that's why. So mine's going to be a lot different because I still want growth in my portfolio, but I'm at a different stage. I'm in my early 40s, getting ready to retire by my mid 40s. And in order to do that, I'm going to need income. I'm going to need income from dividends. So I still have more selling to do, and we'll get to the growth slide here in a little bit. I'm going to have to convert more of that growth into more dividends so I can get, more dividend income to live off of. So that is why I'm double what I recommended. I'm at 40%, even though the goal for a younger person is generally about 20%. And another thing to note on that 20% would also be DGIF. Okay. So I would only want you buying, United Healthcare and Nike and, Home Depot and Skyworks Solutions and NVIDIA, those kind of stocks, Microsoft. Those are the kind of stocks that you'd be buying and have 20% in if you were doing a young person's growth portfolio. All right, up next is the growth section of the portfolio. I'm sure a lot of you are here just for this. And a lot of you are actually going to be surprised when you see this. And you got to remember again that I'm at a different stage. So when I'm doing, you see me doing all these growth videos lately, and that obviously that's been the trend, and I'm invested in all those stocks. If I were 25, I would invest differently, but I'm not. Let's take a look. You'll see what I mean here in a minute. Amazon, by now that it's my biggest holding. I've been bullish on it since $500. Amazon could get broken up. In most cases, if that happens, it's probably going to benefit you as a shareholder, because Amazon Web Services alone, I see people saying that it's worth, $1,500 a share just for AWS. I'm still bullish on Amazon. I had some Amazon and a retirement account and actually sold it, but I was buying that to flip it. I bought it at 1,700, thinking it was going to go to 2,500, which it did, and then I sold it, at 2,450 or something like that. So I took those profits then, and then I bought some VOO, which is the Vanguard S&P 500 with it. And then I also bought some WCLD. So this is a different, not to confuse you, I sold some Amazon in a different account, in a retirement account. This Amazon you see here in the fired portfolio, the taxable account, I've only added to it. I haven't really sold anything for quite a while. Google, again, another core holding. You can see the little carrot. Splunk, which it grew from a smaller company to a larger company, and it grew into a core holding. And that's kind of what you want. You want to buy companies like Datadog and Fastly. You're buying them now, but you're buying smaller chunk because it's, higher risk, and you're hoping that those grow into the Splunks and the Salesforces over time. So CRM, ServiceNow, you can see a trend, guys. Amazon, AWS is the main reason I own Amazon. Google, I like YouTube. I like their artificial intelligence. I like their cloud services as well. Microsoft, you saw on the previous slide, that's considered DGIF, but it's still part of my core, and it's still considered growth. I like them obviously for AI and for the cloud. Splunk, I've got videos about Splunk, but machine learning. I like the machine learning, their AI. I like the fact that it can help businesses with data and information. And it's a lot different than like a Datadog, because Datadog is only for SaaS. It's limited in the type of information that you can import into it, things like that. But I like both Datadog and Splunk. So Salesforce, ServiceNow, then you got Workday, which is not a core position, but it's pretty close to it. I have a little bit less percentage of Workday than say ServiceNow or Salesforce. Square, Trade Desk, Fastly. Fastly's one that I was buying, between $15 and $20. If you're part of the Fired Up Wealth Facebook group, I was saying Fastly's going to be a $50 stock within 3 years. This was literally before Fastly's earnings a couple weeks ago, and it hit $50 yesterday. So I I was a little early on that. Maybe it'll be $100 in 3 years. I don't know. But I am proud of Fastly because it's one that I identified, and I did a video back in June of 2019. I was buying it and trading it and doing all kinds of things with Fastly. So those are the kind of stocks that have helped my portfolio grow. I've done that with a few different names like that. NetEase is another one, which is Chinese internet kind of tech stock. I rode that thing, for a major gain from $35 to $350 over a few years. Take-Two Interactive, been in that a long time. Of course, Red Dead Redemption, Grand Theft Auto, NBA 2K. I like them for their esports. PayPal, random useless information. I used to sell on eBay, and I used PayPal in 1999. I was one of their first, 2,000 people to sign up. So you think like Elon Musk, started PayPal back in 99. You're talking about 20 years ago. I was using PayPal. So that's how old I am, guys. New Relic. Yeah. The thing about New Relic is that they do similar things as Datadog and Splunk, but they're not as good. And I like the company because of they've got this one product that I really like, but most people aren't really that bullish on it. I don't own a ton of it, but I do have a position of New Relic, and I'm still holding it. I actually have a sell order in though, so I've got a sell order. If it hits a certain price, it's gonna go away. CrowdStrike, been crushing it. Cybersecurity, love it. Ring Central. If you like these anything on this growth category, we've got videos on the channel that cover all these in more detail. So I'm just going to go through them kind of quick. Ring Central is one of the top 3. I'll put up a card here. Top 3 stocks I'm buying to hold for the next decade. That was Ring Central, that was Splunk, and that was Zscaler. All 3 of those companies have crushed it, especially Zscaler. Thing's been on fire. Blackline, I did a video. I'm buying this SaaS cloud stock. That one we bought, 57, and I think it's up to 85 or something. It's made a good run, so a little late on that one. If you're looking at Blackline, I think I would wait for maybe a little pullback. Autodesk, I like this one because if you're familiar with Adobe's story, with Adobe, they went from the on-prem and switched to the cloud SaaS type of model, the subscription-based model. Autodesk is doing that. They also have this product called Maya. It was used to create Frozen 2 with Disney, but it also was used to create Avatar. And Avatar has a series of new movies coming out. In fact, I was in New Zealand March of 2019, and I was actually at Weta Works in Wellington, New Zealand, and they were shooting the movies there. So it's pretty cool. Got to see a few things. We couldn't take pictures or anything, but we got to see some behind the scenes stuff. So that's going to be amazing. I'm not sure when those are coming out, but look for the new Avatar movies. I think Autodesk has a bright future. I think that's one that will be like an Adobe. You're going to look back in 5 years and say, why wasn't I buying Autodesk in 2020? Elastic, there's a video out there. One of my more popular videos, it's called Phaser, the next FANG, and Elastic is one of those picks. So Elasticsearch, it's similar to Google, but it's different. It's more for businesses to do data mining and things like that. Zscaler just mentioned, but internet security, and it's one of those work from home, stay at home economy type stocks that have really benefited. Paycom, that one, they right before the pandemic, they were entered into the S&P 500, and check that company out. They do a SaaS HCM, that's human capital management software. I really like them. I also like another one that will be coming up here. Intuitive Surgical, we mentioned earlier. It's robotic surgery. Been on that for a while. Shopify, you probably know Shopify. Things ran up like crazy. They have a deal with Facebook to do shops now on Facebook. I think there's a bright future there with Shopify still. Teladoc, I did a video on them before the pandemic, and then the pandemic happened, and the stock doubled. So I was lucky on that one. I bought it at like $95 or something like that, and then it went to 200. I think it's pulled back to 160 or something, but it's still up, pretty big. ZG, you can buy Z or ZG. ZG is Class A shares. There's also Z, which is Class C shares. This is Zillow Group. PagerDuty. It's tough doing these videos because I want to be confident and say, like, I know this is going to happen. But then if I say that and everybody goes and buys the stock, they're going to come back and say, why'd you do that? So it's not to waffle, but if I do a video on, should you buy this stock, I'm not going to do the video unless I'm buying the stock myself, unless I think there's opportunity. So am I right every time? Absolutely not. But my stats are pretty good. So if you play them, Blackline was a home run, Fastly, Zscaler, Ring Central, like all those videos we did, even Zillow Group. I was saying to buy Zillow Group in 2019, and then during COVID it got hammered, and I was buying it low, and that thing has ran up big time. Twilio is another one, same deal. Adobe, Cloudflare, which is similar to Fastly, but there are some differences there. But don't sleep on Net, because I think, Fastly, CrowdStrike, and Cloudflare, those three, I think those are critical companies for, not only now, but the economy going forward. And it's hard to say if you're going to, buy either Fastly or Cloudflare. I'd probably buy Fastly, but at the same time, Cloudflare is a really good company. And when there's two businesses like that, a lot of times I'll buy the one that I really like, and I'll buy a little of the other. So I bought a normal position of Fastly and a half position of Cloudflare, kind of as a hedge. But I think both of them can actually survive in this environment and do well long term. Viva Systems. So Peter Gassner, was a PeopleSoft guy for Oracle, and he created Viva Systems. They do ERP, SaaS software basically for healthcare, but really for biotech. So when you think of biotechnology companies that have to do these clinical trials and they have to manage all this different data, anything life sciences, there's a lot of additional work that goes into it. You can't just buy Oracle or SAP out of the box or regular ERP and plug and play. Viva Systems is really crafted for the life science industry. And because of this whole COVID-19, this company has benefited because, so many more companies are doing these trials and they're investing in software like Viva Systems. Up next is Paylocity. I mentioned earlier when I was covering Paycom, there's another HCM play that I like. They also do HCM SaaS software. It's kind of the same deal as what I just explained with Fastly and Cloudflare. Workday, Paycom, Paylocity, they all kind of compete in the HCM SaaS universe. I think there's room for all of them though, and they all have done well. So I own a little bit of all three. Glue Mobile, this is one that I crushed it on Glue Mobile. I bought it like $2. It went to like 11 something. I sold most of it. I took profits and bought one of the DGIs, but I kept, I don't know, $2,000 or $3,000 in Glue just as house shares, because I literally was up 580%. And so I kept the original investment. It was like $3,000. I kept the original investment and just let it ride. I sold everything except the original investment. And now it basically dropped from 11 to like 6, and now it's back up to 10. Just today, it was up another 8%. They do mobile gaming and some really silly games that you might think are kind of lame, but they make money, like Kim Kardashian. I don't know who plays those games, but apparently a lot of people do, because if you look at the amount of bookings and the last earnings call, obviously with the pandemic, it helped them too, but I've liked that company since like 2017. There's another one called Zynga. I used to own Zynga and I sold that for a big profit, but I do own a little bit of Glue still. And I don't know, I think I can go a lot higher, and it's probably an acquisition target. MongoDB, it's a really disruptive technology. So coming from Oracle, we obviously did a lot of databases, and MongoDB kind of disrupts that whole database mentality. It's more open source, interesting company. Datadog, I just did a video on, and if you want to know more about Datadog, take a look. And I keep pointing that way, and this camera's backwards, so it's probably like that. But Datadog, I did a video of Datadog versus Splunk. I also have a video on Adka. It's Adka versus Ping Identity. I don't own Ping at this point. I did for a little while. Adka, it's about security and basically user identification. AYX, this is Alteryx. It's an interesting company. It's another one of the cloud type plays. And then Appian, and this is part of Phaser. So Elastic and Appian are both in Phaser. If you're interested in what either of those companies do, take a look at the Phaser video. I think I'm pointing the right way. It's backwards, so I think this is the right-hand side on your screen. So anyway, so this is the growth section, the growth bucket, the growth pillar of the taxable brokerage account. And I want you to guess to yourself, how much do you think this is worth? And you're probably going to be wrong. You saw what the other values are. So the last one, if you're watching the DGIF series, you saw how much that one was. When you see my channel and you see my page, you're going to think this is probably the largest bucket, but it's not. And the reason it's not is because, again, I'm getting closer to early retirement. So I'm still playing, with these growth plays, but not like I was in my 20s and 30s. I'm more conservative at this point. And the lesson I'm trying to bang home is that when you're young, you have to invest in growth. It's the only way you're going to get ahead. The story I have is when I first started investing, I did just dividend growth investing. I would put in like REITs. I'm like 20 years old, like, oh, this is great. I'm making 5% and I'm holding on to this REIT. This is great. And then the problem is, I had no growth, and so it took me a while. And this is part of the reason I made the channel, is because no one was, there to tell me, hey, idiot, like, and don't take offense to that. If you're 20 years old and you like to invest in REITs, it's totally fine. But what I'm about to say is a fact, and it just is what it is. If that's what your risk tolerance is just to go invest in REITs, go invest in REITs or whatever, right? But when you're 20 years old, if you want your portfolio to grow, you're going to need some growth. And back then, the stocks that would have been in that growth bucket are completely different. So look at secular growth trends. What are secular growth trends that you can benefit from? And I've done a series on this as well. So cloud, which obviously the majority of this is in the cloud universe, but you've got, legalized marijuana, which is going to be spec, but it's a secular growth trend. autonomous driving, right? Fintech, right? 5G. So those are important plays. And, you know, the fintech and 5G, a lot of those are in that DGIF bucket because in 5G, you got things like Apple and Skyworks. Those are all dividend payers. So the point being, though, I invested in growth, not right away. I learned the hard way. And then I switched my strategy. I made good profits, and I've been converting those profits over the years into these dividend stocks. So the total for this bucket is just under $300,000. And that's about 25% of assets, which honestly is still pretty aggressive for where I'm at, trying to do early retirement in a couple years. I just think that these have at least a 5-year run where they all can perform well. If I hold all of these companies right here for 5 years, I think it's going to be worth a lot more than $297,000. But the reason that I only have 25% or so of my assets into the growth bucket and not 40% like on the video I did previously is because of my age, because it's going to change as you age. So I'm hoping that this gives you a little bit of an idea of how this strategy works. It's fluid and it's moving, and it changes as you get older, your risk tolerance and things change. Can you just buy a stock like Coca-Cola at 20 and hold it forever? Yeah, that's fine. There's nothing wrong with that. But if you want to outperform the market, you're going to need to invest in growth. But at a certain point, you're going to want to take some of those profits and you're going to want to put them into something that's safer, like the Coca-Cola. So I say, go buy, if I'm 25 years old, go buy WCLD, which is the ETF if you don't know how to play these, or, go buy Zscaler and Fastly and Twilio and PagerDuty and Elastic and Appian. Go buy those five, 6 stocks, whatever I just named off, and let those grow in 5 years. And in 5 years, take half of the profits and go buy Coca-Cola. Think about that. And look at that over a 20-year period, the performance, it's absolutely insane. So, I mean, in 20 years, there's only been 1 year that I underperformed the S&P. Every other year, you're outperforming the S&P. Most cases outperform the NASDAQ. And so even a couple of percent in a year doesn't seem like a lot, but when you compound that over 20 years and as your wealth grows and, the older you get, the more money you make, the more money you make, the more money you save, and it just snowballs. And before you know it, you've got, a nice portfolio. This portfolio is just the taxable brokerage. So I have retirement accounts and my wife has retirement accounts that have, good amounts of money in those as well. This is just a taxable brokerage. So think of like you've got extra money, after you've already maxed out your 401k and your Roth and whatever when you're younger, you're taking an extra $5,000 or whatever and throwing it into this taxable brokerage. This brokerage has grown into, over $1 million, but it didn't happen overnight. It took a lot of active management, a lot of time. So hopefully this slide helps and gives you an idea of what I have in my growth bucket of my portfolio. All right, up next we have the speculative bucket. And you'll remember this exact slide from the previous video, the growth portfolio video. And you'll probably notice a lot of the same stock picks actually. So Virgin Galactic, Beyond Meat, Planet 13, which has been on an absolute tear over the last few days, Ianthus Capital Holdings, Green Thumb Industries, VBIV, which is VBI Vaccines. If you remember the last video that I did, this exact slide, I said that, VBIV was, I think, 90 cents or something at the time. And I told you it was a good spec play that would probably be at least $2. Well, in 2 months, it was $2.50 or something like that. And then it contracted back to $2, but I'm up over 100% on that one. This is Charlotte's Web. I have a little bit of Aurora Cannabis. It was just house shares after. So I bought Aurora Cannabis in 2017 for $1.50, and then sold it for like 11. And I kept a few shares. I'm not even sure why, but I thought it was going to go higher. And it's actually about at par of what I bought it, I think, now after the split, and it ran up after the split. But yeah, Aurora Cannabis, Dixie. You can't even actually trade this anymore. It's being bought out. I only have a really small amount in there, but This is Nikola. That's the hydrogen trucks. In fact, it just merged today, and I picked up a little bit just to flip it. Basically, it's a spec. It's a small amount. True Leaf Cannabis, Canopy Growth, Hexo, DraftKings. I'm up like, I don't know, 75% on that. SLQT. So that's Select Quote. That was an IPO this week. Just picked up a little bit as some spec. So these are the spec plays. GMBL. So this is esports gambling, is one that was brought up in the Fired Up Wealth group, and that's what's great about the group is I had never heard of this. It ran really hard up and then it fell, and now it's kind of found a footing. It's going back up again. So I don't have a lot of money in spec anymore because of the reasons I mentioned earlier. Just where I'm at in the stage, I'm close to end game, and so I only have a few percent of assets. It's way less than the 10% goal that I recommended in the growth portfolio. And obviously the reason why is because, I'm close to end game and I don't need to take the risk. I've already made the capital. Now I need the capital to work for me so that I can retire early and enjoy life and not have to do the rat race anymore. Okay, so this is going to be a new bucket. So if you're familiar with the growth portfolio video, there wasn't a rebound flip bucket. So you can call this whatever you want, but I thought it was better to separate it. So here's some of my rebound flips that I've bought over the last, month or two. Live entertainment, we talked about it in the group. It's made a nice run. All of these have, come up way high from the lows. Now Chuk, there's also CCL. This is Carnival. Chuk is the PLC, and the only reason I own Chuk is my last name is spelled exactly like that, except you add an A to it, and it's kind of corny, but that's why I have the PLC. I had it before the pandemic, and I added some when it dropped. I'm still in the red, so this is one of the few holdings in the portfolio that are pretty deep red. Boeing and Carnival are my two biggest losers by far. Regeneron, I bought as just a rebound play. This is BBW, not the BBW you're probably thinking of. This is Big Bear. This is not the BBW you're thinking of, as someone reminded me. This is this is Build-A-Bear Workshop, and it's a retail play. It was probably going to go to $6, and it got crushed. It went to like $1. I was actually trading some and didn't get out of it, and so I just doubled down, and I'm pretty much at par on it right now, just trying to ride it back up. Fidelity National Financial, this is title insurance actually. So you think of when you close a house, you need title insurance. This is just a rebound play. It was beat up really bad, and it's come off the bottom real nice. Expedia, this has made a massive run. We talked about it a few weeks ago in the Fired Up Wealth Facebook group, and we started buying it. Macy's, which is it's a rebound play, but I also had some. I had some as yield that I bought with profit, and it got slaughtered. I added some when it dropped in March, and I'm actually still slightly in the red on this one, but this is one that as soon as it goes green, I'm going to be selling. This is about as bad as the Dow Chemical purchase. So like with Carnival and Boeing, I don't regret those because a black swan happened. And if it weren't for the black swan, those companies would have kept, killing it. These other companies like Macy's was already dying, and it's not a lot of money. It's like a couple $1,000. It's not nothing. But I had that in there as dividend, as DGI, and I try to get cute sometimes. Like, well, I've got too much tech. I'll try to buy some of this other stuff, and stick with what you know. Just buy what you know, because Macy's a great example. Marriott's a rebound play. I like that one actually. Another one's PK, which is a REIT that you can, and I have that in my retirement account. Delta Airlines, I think all these airlines are going to recover over time. This is not a lot of money. It's about $24,000. So it's tiny. It's just a small amount for trades. And do note that I recently sold Penn National Gaming. I bought that and flipped it and made, I don't even remember what the percentage was, but it was a pretty massive gain. I want to say it was like 85% in like not even a month. So I took those gains, and I actually bought WCLD with those gains, I believe. So those are the rebounds, flip plays. I was going to do a video just on these, but you know, here you go. Bonus. It's like one long video that has all kinds of cool stuff in it. And I'm going to put timestamps on it. You know, feel free to jump around to different parts. So 5% cash is always the goal on the growth portfolio. Honestly, I should have more cash in my portfolio at this stage in the game, but I am at 64,921, which is on target. So about 5% of assets in the taxable brokerage. You want that cash, you know, to be liquid. You want to use it for any kind of dips of the market, any bargains you see. You know, say someone has an earnings that there's a knee-jerk reaction where the stock falls 15%, but you look at it and say, that earnings wasn't that bad. You know, I'll use this money to buy that. And then, you know, as I get paid each week, each month, I put more money back in there to replenish that cash. If I need to, I shave, you know, some profits off and replenish the cash, you know, until I find out where I'm going to deploy the money. So shaving profits, keeping your cash allocation. It's always important. You know, cash is king or cash is trash. I don't know what, you know, camp you're in, but no matter what camp you're in, always have 5% is what I say, because no matter how cute you think you are, how good of a trader you think you are, there's always going to be an opportunity. There's always going to be something that you miss, and you got to have some cash. So you might even want more than 5% depending on how much money you have in your account, your age, your risk tolerance. But I'm telling you right now, not having cash, like back in March when everything fell, a lot of guys didn't have any cash. I was sitting on like 10% cash, and I was able to buy stuff. My portfolio is way higher now than it, you know, all-time highs by a lot, because I was bottom feeding on stocks I already owned, you know, like Splunks and Z-scalers and things that I've already had in my portfolio, and their values got cut in half overnight, and I was buying that stuff with this cash. So always have some cash, because you never know when the opportunity is going to happen. We just went through all 120 holdings. I know there's going to be lots of questions. So please, in YouTube, go ahead and ask your questions down below. There's going to be questions on, why do you have so many picks? Why do you do this? Why do you do that? That's fine. You want a question, you know, go ahead and whatever question you have. There's nothing that's going to be a dumb question, nothing that's going to offend me. Go ahead, drop a comment below, hit the like button as well while you're at it. I want to get this in the algorithm so other people can see it. But I will say, before, you know, we go any further about questions, the reason that you would have this many holdings is only if you have, you know, obviously a lot of capital. Now, you could argue that if you diversify too much, that you'll not outperform, you'll underperform. Because I've actively managed this account, it has outperformed consistently over a 20-year period. It's not for everybody though. And I have retirement accounts where I just have straight up ETFs and I don't want to deal with it. You know, depending on your risk tolerance, your age, your suitability, all those different things, there is not a one-size-fits-all approach to building a portfolio. And there might be someone that has a $2 million portfolio that has 20 holdings, and that's totally fine. For me personally, because of my journey and wanting to retire early with dividends, I'm hedging as much risk as I possibly can. I'm actively managing that risk. And it's important. Once you have capital, once you've accrued capital, you've gained the capital, you need to preserve capital. And that's what this portfolio is doing. You know, if a company explodes, you're not going to lose a significant part of the portfolio. To give you an example, Amazon is the largest holding, and it's about $60,000. So some of these holdings are, you know, $5,000, some are 10, some are 20, what have you. But the idea behind it is, if you take, you know, 1.2 million and divide it by 120 holdings, of course, the average is about $10,000 per holding. $10,000 is still a lot of money to me. I'm like I mentioned earlier, I'm from humble beginnings. I didn't grow up wealthy, anything like that. $10,000 is a lot of money. And so I'm not trying to lose $10,000 on a bad pick, et cetera. Now I'm actively managing this. So the core holdings are holdings that I feel like I can hold for 5 or 10 years. And a lot of these stocks are, but there's a lot of stocks in here that are simply just flips and things like that. So feel free to ask questions, fire away in the comments below on YouTube. I'm happy to address them. One thing I did want to address real quick is, if you recall seeing this heat map in the beginning of the video, this was actually a video that was intended for YouTube. And in that video is 20 minutes long. I explain in that video what I'm about to explain to you now. I realized after recording this entire video and watching it that I failed to mention this part, so I needed to edit it back in. What you're seeing on your screen right now is a heat map for an account in Fidelity This, at the time of the recording, has $1,020,000 in this one account. Now, the portfolio actually has 3 individual brokerage accounts, taxable brokerage accounts. There's another Fidelity account, taxable brokerage account in Fidelity that I use for day trades, and that's where the majority of the cash lies. The reason for that is I like to do day trades. I like to keep my mindset separately. So if I'm doing a day trade, it's 5-minute, 10-minute, 20-minute type trade. It's a completely different mindset than if I'm using this portfolio for long. I do have some, swing trades in here and things like that, but those you don't have to pay attention to. You can buy them, let them ride, and usually there's a technical level that I'm buying something on a swing trade, and I generally put a sell order in right away, so there's not much thinking. You can not worry about it and watch it all day. On a day trade, you're literally watching the chart as you trade it, so I like to keep that account separate. So the majority of the cash in the overall portfolio is in a separate account. And because the account is different from this account, this heat map is just showing the one account. This has a little over $1 million in this heat map here. If you go through all the slides and you add up everything on there, the ETFs, everything, you'll get about $1.2 million. The only discrepancy other than the cash is going to be in the ETF slide. If you look at the DGI stocks, all the dividend stocks are in this account. All of the growth stocks that you see are in this account. All of the speculative plays are in this account. All the rebound swing trades are in this account, etc. The only other discrepancy other than the cash is going to be the ETFs. The reason for that is there's a third taxable brokerage account that's with a different brokerage. It's actually with TD Ameritrade. And the reason it's with TD Ameritrade is back several years ago when I was doing day trading, it used to cost $5, sometimes $7 every time you bought or sold a stock, and it added up. TD Ameritrade had a deal where you could get 100 free trades. At the time, Fidelity wouldn't match it, so I started an account there. My trading account was with TD Ameritrade, and I really like the Thinkorswim in there. It's probably the best trading platform with TD Ameritrade. So I was doing a lot of active day trading, and I got really busy with work. I started traveling to the United Kingdom for work, so I stopped trading in there, but I didn't want the money just to sit there and not do anything, so I threw it in some ETFs. The problem is now, if I sell them to roll them into this big account, I'm gonna have to pay taxes on it. So they're literally just sitting there. They're part of the overall portfolio, but they're in a different account than this heat map account. If you have an IRA, like Roth, 401k, whatever, any kind of retirement account, you can transfer that without any penalty, and you don't have to pay any taxes if you do it correctly through brokerages. With a taxable account, if you have a Robinhood account and decide to open a Fidelity account, you can't transfer those funds into Fidelity. You're going to have to liquidate, sell everything from your other brokerage account with Robinhood, pay taxes on that, and then buy the securities again. And that just doesn't make any sense. So again, the heat map you see here at the time of the recording of the video is about $1,020,000. After Friday's run, it's over $1,050,000. And then there's a second account in Fidelity that has about $50,000 in cash. And then there's an account outside of Fidelity that has about $150,000 in ETFs. Of course, those aren't going to show up in this heat map because they're actually separate accounts. So this is the main account that I use in the portfolio. So I just wanted to clarify that in case you were wondering. All right, guys, there it is. That is the entire portfolio as of now. This is early June of 2020. Obviously, it's going to change almost every day. It's actively managed. So again, if you want to stay up to date with what's going on, if you want to learn more about the different stock picks and just stock market investing, general finance, financial independence, retire early, subscribe to the channel, click the subscribe button, click the little bell that gives you notifications. That way, when a new video comes out, you'll get notified right away. Also, check out our Facebook group. Go on Facebook, type in Fired Up Wealth, do a search. You can apply for a private group. There's also a public page. Thanks for your time. Thanks for your attention. Appreciate you watching. Have a great rest of your day. Take care.